Joe Goldberg commented saying, or you could just stop following this flip-flopper and just buy XEQT, own the entire global stock market, call it a day, and live your life. Geez, boggleheads for life. Hello, darkness, my old... Yeah, I'm an absolute flip-flopper. I'm here for the memes, the entertainment, the value of trying to outperform the market, and that's what I do, and I have flip-flopped recently. We're going to talk about XEQT, my $400,000 dividend stock portfolio, what I'm doing, and just my general thoughts on this current market environment as we're in earnings, because I just sold Taiwan Semiconductors. The rest of my position, anyways, as I said, I was waiting for earnings. Earnings came through, and yeah, I thought I'd be holding this position for a lot longer, but the fundamentals are changing, folks. We are in a recessionary environment, and I don't trust anything. I don't have the fortitude my fiance does to just lock it in and walk away for 20 years because I've been analyzing this crap on a daily basis. And TSM, for the first time on their monthly revenue, saw a big deterioration from this time last year. They posted it in their guidance. They post, though, on their EPS for this quarter 500%. Against what analysts were expecting, and the stock could barely rally on it. So I'm not really sure where this company is going in the future. I have a lot of high hopes for it, but in the macro here, I don't trust anything, and I wanted to lock in the gains I got from buying this between like $70 and $80 a share. I made a few $1,000, and I'm just going to sit back and patiently watch what happens moving forward here. And we're going to talk a little bit about this when we get into my portfolio, but I want to bring in that conversation that kind of comes into play with Tesla, because FitBH says, Kyle, will you make a video on Tesla? And I did sit through the Tesla earnings, as I'm sure many of you did. We watched Starship take off and explode this morning, but Tesla's trading down about 8%, give or take here, and it's the only company in the world where you could sit down on an earnings call, watch their free cash flows deteriorate, listen to the CEO say, hey, we could sell these cars for nothing, but self-driving is going to propel us and make these cars we could sell for nothing worth so much in the future. And he says, I think this year, as he giggles, that it'll be ready, even though he's been saying that since 2017. I'm not trying to be like critically bearish here, because long term, I'm excessively bullish on Tesla, but that's from a speculative standpoint. People don't understand that, like, there's no other company in the world that could say they could lose money on their vehicles, but some technology that's speculative in the future could make up for it, and people would be bullish on that, right? Now, for me personally, in this kind of a market, right, if you're looking for these speculative investments, you're going to want to see them dip further because they're kind of overvalued based on the current fundamentals. So when they start coming down, again, if Tesla gets back to that $100 a share price point or below, it's a huge buying opportunity. But if you have a long-term vision, you're 20 years old, I don't think it's a big deal to cost average into it from here. But for me personally, I'm like thinking like Warren Buffett, right? Like, look at what Warren Buffett's doing. Look at the fear that guy has in this market and the stocks he's buying. He's buying commodity-based companies, oil companies. He's buying things like Mitsubishi Corp and these commodity trading companies that have monopolistic like qualities that are based in Japan. You can really tell Buffett does not like this market because, again, things are slowly deteriorating. Again, as interest rates go up, it's like gravity and it's pulling speculations down with it. So with companies like Tesla, any of these small caps, you have to understand the risk that you're taking and mitigate your percentages in them accordingly, because we ain't going to be seeing 1,000+X returns in cryptocurrencies and Pokemon cards like we've seen in the past, at least until this market environment levels out, which again opens a door of buying opportunities. So you want to take the entire market into consideration and keep an eye on speculations. Don't like write them off. Just look at them at the right price points where they start making a little bit more sense to take on a speculative bet in your portfolio. And on that note, just taking a look at my portfolio, we can see it's around 403,000. I've got a nice decent amount of cash. We're sitting on some gains right now from my cost averaging, and this doesn't include the gains that I obviously just took on Taiwan Semiconductors and all that stuff. But taking into consideration here, I have removed my speculative investments to give you the pure broad view of the primary aspect of this portfolio, because I do own small caps like Aduro still. I still obviously have some private placements I don't discuss on this channel because I've been waiting for them to come public. There's no point talking about a pure speculation that isn't even publicly traded that I can sell out of, but they're doing their first shareholder meeting this week, which is kind of intriguing. But taking a look, I'm taking this broad view of the Canadian and US markets as mentioned, with a broad-based ETF and a core focused dividend ETF, so US VOO, SCHD for dividends. Canadian side, I'm now taking XIC, counterparting it with VDY, and we can see that I just started buying XIC. I got 10,000 in there, again bumping the dividend up a little bit, especially with those gains from obviously TSM. So we can see I'm sitting at $13,764 in annual dividends, taking into consideration that I also dumped another $5,000 into a high interest savings account where I'm getting 367. The high interest savings here, and it sucks. Scotiabank's only giving me like 2.5 or 2.6%, but hey, it's just somewhere for a Parker Place for cash for the time being. Now I want to round back to that first question. I want to talk about broad-based ETFs, along with two ETFs that look like they're Bernie Madoff style charts. Like they don't even know a recession's happening. They've done nothing but gone straight up into the right. But firstly, if you want to support the channel, come on over to portfoliospreadsheet.com. If you like the way I track my portfolio here, bring all your accounts into one place, track your dividends, convert your Canadian currencies to US or vice versa. It's literally $15, a one-time price, buy one, get one for each platform. Personal finance trackers are sold separately. If you want to keep track of your monthly cash, your investable cash, what you have left over after expenses as well, you can use coupon code dividends and you'll get 30% off. Link down in the description below. But kind of coming back to this, because I do believe I'm a bogglehead, I don't think you should be listening to any YouTuber about what they're buying. I mean, there is no one size fits all shoe for investing, but I did reply. I tried to offer a little bit of insight here because I think for a lot of people, you can tweak this a little bit. I think XEQT is an incredible ETF. I just said probably the easiest thing to do. However, I would pick a global market ETF with a lower expense ratio because I found this one to be pretty high. We'll look at it in a sec. And with one that actually holds the securities themselves is with XEQT, you're paying someone a big fee to just buy the ETFs I'm buying anyways. Just look at their top holdings. Thanks for the comment and stay diligent. And just taking a look at this ETF itself, and it's very intriguing. Like I said, there's nothing wrong with this ETF. If you just have a full-time job, you're very comfortable and you're safe in your life, emergency fund, all that jazz, you don't want to worry about stocks, you could just buy this and forget about life. Because we can see that the dividend yield's not high. We're not using this as like some kind of backup income. It's more of just a retirement account type of investment. And again, the fees are a little higher than I'd like it, around 0.2, considering when we take a look at the top holdings, they're just buying iShares Core S&P Total US stock market, which you could just buy VTI, would come with a lower expense. So we can see we have XIC, which is the stock that I'm buying now. We can see XEF, which is the iShares MSCI. EF is like a global market ETF, emerging market ETF. And if we just take a look, for those few main ETFs, 43% is US, 24% is Canada, almost 70% of this ETF is US and Canada. You could easily buy XIC and VTI, you get a lower expense across the board and have roughly the same exposure. And if you wanted to add a global market ETF to that mix, that's just my personal opinion. But again, there's nothing wrong with just buying this kind of an ETF in general, which leads into this kind of second question about what you guys are doing out there. That's not one size all fits investing style, right? Because this is a great comment from Nicholas saying, have you thought about pairing VDY with ZLB? It has a lower dividend than VDY, but the growth is much higher. My TFSA is 50-50 VDY and ZLB, which still averages out to be about 3.5% yield with the combined, and it gives me a lot more diversification. And I said, damn, what an ETF, man. I've never heard of this before. And let me zoom back out here because it does remind me of Bernie Madoff. I made a joke about this because someone threw another dividend or growth ETF in there as well. And I wouldn't even call them growth ETFs. Take a look at this. This one's called the BMO Low Volatility US Equity ETF, and ZLB is called the BMO Low Canadian Volatility ETF. And look at the charts on these. I mean, it's like they didn't even know a recession hit. They're basically hitting all-time highs as we speak in this very moment. Look at this. This is literally what Bernie Madoff would send to his shareholders. You'd be like, look at how well we're doing, and he'd just be faking the charts. But let's break these down and take a look at them as investments, because I would almost consider adding these to my portfolio. I'm not there with it yet because I still want to get XIC and these broader-based ETFs added. But man, this could really serve a purpose in my sector-concentrated ETFs. Because obviously, like XIC and VDY are heavily concentrated in financials and energy. But breaking this down, the expense ratio is much higher. It's expected for this kind of performance, and obviously, if I'm paying that high of an expense, I would expect these kind of returns. Which again, I don't know anyone that's giving you this kind of return in this kind of a market. But when we take a look at the top 10 holdings, they're using a mechanism, a system. I wouldn't say a mechanism. They're kind of like hand-picking companies that follow this suit of low volatility. Very intriguing things like Clorox, Merck & Company, Campbell Soup, JM Smuckers. You get an idea, right? And if we take a look at the sectors, consumer staples, utilities, healthcare, financials, you can see the 50% of this is just those really recession-proof kind of investments. And on the Canadian side of the border, we're seeing the exact same thing. Their top holdings are Hydro One, Fortis, Emera, Metro, like some of the Barrick Gold, Loblaw, some of these companies that I've talked about recently. And again, financials still being the largest proponent at 20%, but utilities, consumer staples, and industrials being a much bigger proponent. So who knows, maybe these will work their way in my portfolio at some point, because again, pairing this with VDY would be very, very nice and a very intriguing idea to say the least. And we'll answer one more question from JT saying, hey, Kyle, can you explain more about wanting higher dividends? If your income is less stable, do you use those dividends to pay for things? Aren't they taxed when you withdraw them from your RSP? I would just keep buying more with them. So currently, yes, I am just reinvesting the dividends. However, my job is highly unstable. Like my income is very choppy. Though I make six figures a year, I'm always expecting that I could go to zero tomorrow because it's purely based on me being able to do the work. I don't get a salary. I don't get unemployment if I lose my job. It's mostly contracted based, right? So if something happens to me, I don't got any more income. It could really drop off pretty substantially. So I like having that 3% as a healthy backup that doesn't hinder the long-term growth of the equity of these investments, but I could tap into it, use it to pay for bills. And yes, if I pull it out of my RSP, you're going to pay your nominal income tax bracket rate on it. If I pull it out of my TFSA, I'm going to pay no tax on it. And obviously, if I pull it out of my corporation, it comes at different tax, implications. Yeah, it's going to be different across the board. But again, for me, in my current life circumstance, I like the balance of growth and yield. And this is where I sit in this current moment. But I'm going to do a full video down the road breaking down those two ETFs. I'm going to do like a full proponent of what they're made up of. So if you'd appreciate that, consider subscribing for those updates. And as always, let me know what you think in that comment section below.